my right is Chang, who is the global editor of ICIS Chemical Business, and to my left is Westervelt, who is the editor-in-chief of ICIS Chemical Week. And I'm sure all of you read their periodicals, so you understand why they're highly qualified to talk about what the industry outlook is. And what we're going to do is I'm just going to present a few slides at the beginning just about the global economy and the chemical economy, and then I'll turn it over to each of my two co-panelists to make their comments. Each one has about 3 slides or so, and then we'll have a discussion at the end. So I'll start out basically the global economy, and the reason why is so much of what's going on in the chemical industry is affected by what is a rather confusing and disrupted global economy. And since the beginning of 2022, we really, with the pandemic, there was a plunge in economic activity. The only country that recovered quickly was China because they locked the whole country down. But the conditions of the rest of the world were not so positive. The U.S. started to recover in the third quarter, and still in good position. Through this past summer, the U.S. and China continued to show strong economic growth, and Europe sort of evidenced a partial but anemic recovery. But then most of the rest of the world was really struggling, right? And whether it's India or Brazil, and more recently, no matter where you are, we're suffering some economic setbacks for a host of reasons. And the list actually, we've been commenting throughout the day about some of these factors: the shortages of semiconductors, supply chain disruptions everywhere, rising inflation, shortages of labor, ongoing negative impact of the pandemic with the onset of the Delta virus variant. And all of these and more have essentially disrupted the global economy. And then on top of that, we're going through an energy crisis with high prices and shortages of oil, coal, and natural gas. And depending where you are in the world, it's either what the exact problem in this area can be different. For example, in China, though, they're trying to pull down their use of coal for generating electricity. But as a result, they're having controlled blackouts throughout China. And of course, that obviously doesn't help if you're trying to run a manufacturing plant. So that's really depressed their economy. So, other than that, the world is a rosy place, I guess. But I don't think we've had as many disruptive factors happening all at once at any point that I can remember in recent history. And I think China, as we mentioned before, is going through its own very special challenge because in addition to what I said about the electricity, we all are following the story about Evergrande, which is the big real estate company, and its problems, and the problems with all the other companies in that sector. A number of them actually defaulted on their dollar-denominated debt, and then the government also is clamping down on certain industries that don't fit with their policy, whether it's tutoring, or it's gaming, or any of those things. So all of these things dampen the economy, and the question is, have they created a situation where the Chinese economy falls apart? If it does, believe me, we'll all suffer. So why did I mention that? Because that's part of the potential outlook. In the U.S., things have slowed down, but it's not clear what the forward picture is going to be. Although we're facing rising oil and gas prices, shortages of labor, inflation, disrupted supply chains, and the shortage of semiconductors, we're on a relative basis in better shape than most countries, but still it's really quite disruptive, and it's not going to go away very soon. So I think it's suffice it to say that based on the comments that I've made, we are certainly facing a high degree of uncertainty with regard to the global economy. which makes it really tough if you're running a chemical company to set a strategy or forecast, because you don't know what scenario is the right scenario. And then the last two is just about the chemical industry. I mean, if again, going back the last 2 years, the good news about the chemical industry is that it didn't suffer as much as many sectors. I mean, if you were in the entertainment business, zero revenue is kind of hard to, deal with, or cruise lines, or restaurant businesses, and so forth. Really, really tough period. The chemical industry, on the other hand, on a relative basis, was really in the middle of the pack. There's some sectors that did better, but the chemical industry in general was in the middle of the pack, and the profits have been very strong since the third quarter of 2020. But the reality is averages are dangerous, and in this case, they're definitely dangerous. The chemical industry, it depends on what sector you're serving. If you're heavy automotive, it's been a bad time. If you're significant in cosmetics and leisure and paints and so forth, it's better. So it really varies depending upon who you are. But then on top of that, as people have mentioned earlier a number of times earlier today, the chemical industry has its own special challenge related to sustainability around plastics and carbon neutrality. And that's going to be a heavy pressure going forward on the industry as it either deals with how to comply with certain rules and goals, or if it's impacted by actions taken on them, whether it's, say, a plastics tax or something like that, that could have a serious impact. So that's a special category because it's not a general economy issue. It's more a chemical-specific, environmental and waste issue. So the bottom line is this. I think it's safe to say that the economic outlook is very complex with positive and negative factors. But the net outlook would appear overall to be positive with the chemical industry, but some sectors might suffer much greater than others. So it really depends upon what you do. But all these factors that I've listed here are really things that are going to have a major impact on what your rules like and what it feels like to be in your particular company and your particular sector. But there are negatives in the third bullet, and there's some positives in the fourth bullet. So these are the kinds of things that you're going to have to wade through as you think about your future, but also things that you can do to affect the trajectory of the future. So that I just want to make a few comments about where the economy and the chemical industry has been and where it's headed, and then I'll turn it over to whoever slide appears next. And it looks like Joe Chang is the okay. We hope Devin eventually gets to some presentation. There we go. All right. Rob, you're up.
Okay.
I think it was random, but you're next.
Yeah. So, you can skip to the next slide. Yeah. So thank you, Peter. It's good to be here. Good to be back alive in a hybrid environment as things start to normalize. And a lot of what I said, really it's going to echo what Peter said, and I'm sure Joe will echo it as well. But I guess the word of the day, if anything, I would say is disruption, right, across all regions, all sectors, all supply chains. But for the most part, we're back to the global GDP is ahead of pre-COVID levels. China is the quickest; it's now slowing. The U.S. followed. Europe lagged. But one of the biggest disruptions, there's been a lot. You've had obviously COVID itself, U.S. storms, supply chain, volatility, energy, which may be a preview of the volatility that could be tied to energy transition, That's caused all sorts of supply chain constraints that have capped output and really helped boost price and margin. And I think it's, chemicals, by and large, margins are Peter said since the third quarter, have been incredibly strong. Starting to feel the impact. You had some of the coatings guys that showed up in their third quarter. It's also the specialty guys had some lag in pushing through pricing. That's starting to spread further upstream, like Dow, Lyondell have warned that their growth is slowing because of the feedstock challenges. So that's starting to catch up. But that said, your markets are incredibly tight, and some figures here about GDP in this range. You see, it's been pretty dramatic rebound. And the good thing is that that should continue into 2022, even if growth GDP is slowing, industrial production is slowing, but they both appear to be above trends for next year. So that does bode well for supply conditions, even as things start to normalize. And go to the next slide there. Again, just another look at global economic activity, which should hold up fairly well into 2022. Industrial production, just give you some specific figures here. After a 3.4% decline last year, we're looking at 5.5% GDP growth this year, 4.3% next year. For industrial production, which is a pretty good proxy for chemical output, it dropped 5.3% last year, up 6.7% this year, and 4.3% in 2022. So those are all pretty good above trend numbers. So that, I think that indicates that the supply tightness will remain with us through at least the second half of next year. And I think, as you start to look out to the medium term, I think there's some interesting things going on. I think capital spending for now appears to be in check. The gases players aside, you're not seeing a big indications of a ramp up in capital spending. ICIS put out some updated figures last week, calling for 3.1% growth in 2022. Capital spending probably doesn't get back to its peak 2019 level in the U.S. at least until 2024. And that's even before adjusting for inflation. So you have, after the massive amounts of capacity, particularly basic chemicals that were added, you have fairly modest additions over the next few years. Like Dow, for instance, said it would. It's obviously it's going to bottleneck and have some targeted expansions, but its next big incremental capacity probably doesn't happen until the new Alberta cracker polyethylene units come on at the end of next year. Last week was the ACC meeting. I had one CEO tell me, why shouldn't I be happy with 2% growth? And even had a couple producers tell me that they're looking at bottom slicing. So if there's no big capacities come on, but they're looking to upgrade the portfolio mix, and I think that fairly bodes well. I think you will have margins, particularly for basics, do return to some normal level. But as long as the economy holds on, I think conditions into next year will remain fairly strong. Just go to the final slide here. Wanted to close. I think one of the big themes, I know Peter is going to close the event with this, but I think sustainability and ESG are the midterm and long-term issues that are here to stay. See some of these headlines here. These are just from the last 2 weeks. Obviously, you have the COP meeting going on now in Glasgow. Lyondell in October committed to net zero by 2050. They had this announcement by Dow in early October, about their net zero ethylene complex. So net zero commitments are accelerating, and it's already driving big capital commitments and portfolio shifts. I mentioned the Dow plant. It's probably at least a $4 or $5 billion investment. Air Products has announced 2 blue hydrogen complexes that are going to be multi-billion-dollar efforts. You've got, a new green hydrogen project every day, it seems. Europe is making billion-dollar investments in green hydrogen. So the capital spending is there. And I think it is going to drive portfolio shifts in M&A as well. I thought Trizio's announcement Friday, their divestiture of Styrenics, was interesting. They said in part, that's driven by a desire to get their portfolio into a position where it can meet its net zero commitments. DSM has said similar things about its resin sale. Obviously, Styrenics doesn't go away. Materials, nylon don't go away, but where does that leave that asset? Those assets that are more energy intensive and harder to decarbonize, we'll call them. Does the private equity step in? But you're ready to start to see portfolio shifts, and companies start to reposition their portfolio to make it easier to make those commitments. Even though obviously materials, hydrocarbon-based materials are not going away, but I think you're going to see some dramatic portfolio shifts. Also, you overlay that with the drive to a circular economy. In addition to the investments to decarbonize, you have massive investments going on in advanced and mechanical recycling and renewables as well. You've seen Peter mentioned different NPOs that have happened. It's obviously a big market. There's been a big uptick in private investment going into. It's not going into plastic chemicals, but it's going into renewables. It's going into advanced recycling, clean hard tech, hard clean tech, I guess you said. The other thing, of course, another element of ESG is diversity and inclusion initiatives to accelerate your commitments as well. In the U.S., you have the Future of STEM Scholars Initiative that most U.S. companies are behind, and it's all about the efforts to attract and retrain the talented resources we need to drive these changes over the next few years. I think that's it. I have a summary slide, but basically that is the summary there. So we go ahead here. So
I'll just say thanks for the invitation, and I really enjoyed the content from the previous speakers. Certainly we're going to get some stories out of this. So.
Well, that's good. That's good. No, again, we try to change the topics to things that people really concerned about. And I think today, supply chain, transition management, ESG, or M&A, these are the things that we won't really worry about. Right? And it's a harder environment right now because there's so much uncertainty. And it's not easy. It's never easy, but I think it's the level of difficulty, sort of like the Olympics, the level of difficulty for the dives is going up, right? And then they've raised the platform.
Right? Good analogy.
Well, for the two of you, it's made for interesting reporting, right? So I think that the things you are writing articles about have really been influenced by a lot of these things, right?
Sure.
You're not lacking for topics these days, right?
That's right.
Yeah, people think of chemicals as an old line boring industry, but like I was mentioning, I've now 25 years, and a lot of that was thinking something. So I'll turn it over to Joe.
Sure.
So we found your slides.
All right, good. And I can kind of bring that conversation forward. Thanks again. Rob and I were just at the American Chemistry Council annual meeting in Colorado Springs. So, a lot of topics, a lot of meetings here. But essentially, I think a key message that came out of the meeting is companies will really try to accelerate that transition to net zero or low to zero carbon emissions. So, everyone's got their targets, countries have them, companies have set individual targets, of brand owners want circularity. So there is that need for more investment, innovation, and even risk taking. There, chemical companies tend to be risk averse, and sometimes for good reason. But you have to really start stepping up some of this and accelerating the timeline. So, and you have to start investing now, even though these targets are intermediate targets 2030 en route to net zero 2050. Companies will probably have to scale up existing technologies. They can invest right now in things like using more hydrogen, blue hydrogen to fire up crackers. You're not going to get the electric cracker. You may have heard people talk about the e-crackers, electric cracking. That might be 10 years down the road, but still, you can still electrify certain processes in the cracker to decarbonize there, and a number of companies are doing that. Newer technologies like e-cracking or ethane dehydrogenation, another way to produce ethylene, that's coming down the road, but that's long term, and it's clear to get the U.S. carbon price that's needed to incentivize things. Rob mentioned Dow. Dow is really taking the lead here. They announced a net zero carbon emissions cracker, and that's in Alberta, Fort Saskatchewan, Canada. I think we asked why Canada. Why not the U.S.? Well, Canada, first of all, they do have a carbon price, so that's an incentive there. They have existing carbon capture and storage, the CCS infrastructure that's critical to achieving net zero, and the government is providing incentives. So essentially, Dow, they're going to take some cracker off gases and they're going to convert that to hydrogen by autothermal reformer. They're going to use that to fuel the cracker instead of natural gas. So that'll result in less carbon emissions, and then the rest of the carbon that's produced. They're going to use CCS, carbon capture and storage, and then inject that into an existing trunk line. I got to say, Dow is really taking a leadership role here. Is they're not only doing this, but they're devoting a third of their capex. So that's a lot. They used to spend about $2 billion a year, very capital disciplined. That's going to ramp up to $3 billion a year, about equivalent to depreciation and amortization. But a third of that, from now until Jim Fitterling says until 2050. Yeah, it's going to be $1 billion a year to decarbonize existing assets site by site. We'll be able to get more details on that. As mentioned, you can't do this without carbon capture and storage. ExxonMobil has proposed a Houston hub for this, a tremendous $100 billion investment. They can't do it alone, or they won't do it alone. This could store up to 50 million tons a year of CO2 by 2030. Just to give you an idea of scale, currently their largest CCS site is in Wyoming, and that's about 6 to 7 million tons a year. So this would be just a real step change. 10 other companies are interested, including Dow, Lyondell, Gazelle, Ineos, so they would kind of share in being able to use this resource. And again, it's really realistically the only way to get to net zero. Get to the next. Sure, and here are just some quotes here. By the way, the American Chemistry Council will, or they should shortly unveil their low to zero carbon roadmap for U.S. companies and their members. And just some of the comments, from that meeting, got to transition to net zero, and you got to do it sooner than later. From the Dow CEO, Dow and ExxonMobil both pushing very hard to have that carbon, the price on carbon, to incentivize investments. Need for innovation. Nebraska America CEO mentioned, it's at an inflection point, we have to change the way we innovate, kind of thinking like a startup company. And just one interesting, I think Accenture presented and noted that globally the investment into startups that's really ramped up for this year. It's the total investment in startups, and a lot of that is in sustainability as well. That'll be equivalent to the entire R&D spend of the U.S. chemical industry. So actually, just go back to, or I think I remember it, but it's also the fact that you're not going to have conventional crackers anymore. So it's going to, you have to put some carbon mitigation technologies into this. So it's going to be a lot more expensive. It's going to be expensive. Also, the capacity, it's going to be slower to build. So the new capacity that's coming on in the US or North America, it's going to be a lot slower, a lot more expensive. So this, there's going to be a gap, and especially if you looked at 2023 to 2027, so Dow's cracker will start up, it's planned to start up in 2027. And Chevron Phillips Chemical, if they go ahead, maybe their cracker starts up 2027. That's an estimate there, and it will be low carbon as well. But you have a real gap between 2023, 2027. No new capacity in terms of ethylene and derivatives like polyethylene. So this is that's going to cause more volatility in a number of product chains going forward. So this is disruptions. We talked about disruptions. More will be coming. I think the Boston Consulting consultant mentioned that as well. But during this energy transition, this move to net zero, tremendous amount of disruption and also shortages, I think, of key materials. Go to the next. Yeah, and really, what are the implications of this? It's so you have the Western countries going to net zero. China has a dual control policy. So at least in North America and Europe, dramatic slowdown in new cracker projects. These massive cracker projects, again, said they have to be more expensive. Europe is a net importer of a lot of chemicals and polymers. That net import position should grow in the future. China also wants to be. They want to be cleaner. They want to be cleaner. So you heard about dual control policies. That's one to cut absolute emissions, and then also energy intensity for a number of industries. Coal to olefins projects. There was a wave of projects where they use coal to produce polyethylene, polypropylene. They're simply not viable anymore. You won't see any more of those. And the companies that do invest there, the Western companies like BASF, their next cracker project will be in China. That's going to be about half the CO2 footprint of a typical gas-based cracker. ExxonMobil is also planning another 100% ExxonMobil owned and operated. I think China is letting these companies have 100% owned investments as long as they are low carbon, and hopefully they can learn from some of those technologies as well. Hey, Middle East also. Middle East, Aramco, Saudi Aramco, they want to get to net zero from operations by 2050 as well, and they're big on carbon capture and storage. And then the other topic, of course, decarbonization, but also plastics recycling. Plastics recycling, that was a big topic at the ACC annual meeting, previous meetings as well, the AFPM. So, you can get there 2 ways: mechanical recycling, of course, as well as now more and more chemical or molecular, some companies call it advanced recycling. So those volumes should ramp up quite a bit. So we talked to the CEO of Berry Global, a major converter. They're essentially telling these companies, look, produce this stuff, we'll take it. Whatever you can produce, we want to take this. It's really driven by their customers and brand owners who have these targets. But they're very confident they can sell this. They can sell this material and are really pushing for that. So, we just launched, I think about a week or so ago, just the ICIS recycling supply tracker for chemically recycled material. We have one for mechanical as well. It just shows you where the supply is, what potential methods they use, and when it's coming on. So we see a big ramp up in the supply of chemically recycled plastics going forward. And again, we're still relatively small compared to the total volume, but that's only going to grow as these brand owners have to meet their commitments. The train is moving; it's not going to stop anytime soon. And that's it.
So let me open it up. So it's interesting looking at your slides, my slides, and so forth. One dominant theme is all the things related to carbon neutrality and recycling and plastic, so forth. And it's costing a lot more money, right? It's disrupting a lot of suppliers. On the other hand, it might have benefit, it might slow down capacity increases and so forth. So how do you see that kind of working out? Is this all just going to be, how's it going to work out for the chemical companies that are somehow, linked into those issues? Is it going to be terribly just all negative, or mostly negative and some positive, or financially from a business point of view? Go ahead.
Yeah, sure. I think it's probably a net, if you look at it, less volume, but it could be, I would only view this as a net positive if you don't have that kind of capacity expansion and the margins. You've already seen pretty good margins so far because of shortages, a ramp up in demand. Even though you won't get that type of volume growth, I think the margins will be pretty good for companies if you don't have that kind of capacity expansion. Of course, it will cost more to decarbonize, so companies will have to put CapEx into this and decarbonize and more R&D. But the fact that you won't get this tremendous, we just don't see the tremendous increase in capacity that we've seen in the past. And you have to wonder, who picks that up, if anybody. Does it all come from recycling, or is it China, just trying to eventually, continue to increase capacity to these levels? What about the Middle East? But I think, again, even the Middle East, they won't, these new crackers will be more expensive. But the margin profile, I'd say it's a net positive.
Yeah, but also obviously the costs have to go somewhere, and ultimately gets pushed out to the end consumer and so forth. So nothing ever has, necessarily its intended consequence, right? And so, Rob, your view?
I would agree. I mean, I think net positive. It's neutral or positive for the chemical industry. think there's a lot of investment that's going to be required, but it appears that there is a willingness to pay a sustainable green premium that has emerged. You lay that with carbon taxes or border adjustments, and I think that will be embedded in the prices. And if you hear the companies talk about the outlook through 2050, there's they're not changing their their longer term return on invested capital targets or their margin targets, and I think there is an expectation that they can get there. And I think one of the things that has changed, say maybe over even just the past year, that there is a path there. Like I thought, Dow's announcement was very interesting, but even there is a path to net zero for the industry. With even as it struck me as that all it takes, just building an autothermal reformer, and you have the ability to fire these furnaces with hydrogen instead of natural gas. That gets down to net zero, which is interesting. So it's there is obviously some capital required there. You are going to need a carbon tax. You are going to need a willingness to pay for decarbonized material, but the pathway is there, and I think you're going to see that upfront capital investment. I think at some point, the significant capital investment starting to come in beyond what Dow's announced, beyond what Air Products has announced. So maybe you get for a cycle somewhat, I won't say challenge, but margin returns. But I think once we get through one cycle, I think we get back to a sense of normalcy. I don't see margins.
No, I believe in the long term it'll work out. The tricky part is the transition, right? And like we're going through with energy now, okay, yeah, you want to cut down on coal-fired electric utilities, but the problem is the other suppliers of electricity aren't growing fast enough, right? So you end up with this terrible situation where you have shortages, right, of electricity, like in China. And of course, over time, though, they can solve it, but in the interim, you have some serious disruptions. I think anytime you have to change and make a big change in technology or processing, the transition can be very, very painful. The good news, though, is that it does appear that customers are willing to pay a premium. I think they figured out that when they net everything else, they really don't have much choice. And I know that for a lot of companies that were producing things like out of renewable materials, et cetera, it was painful because it was hard to convince people to pay a premium, right? Now I think that, Jim Federian, his announcement, when he was announcing $1 billion a year, he said, if my memory is correct, he said, people are paying, 30% premiums for polyethylene that's made on recycled or circular chemistry. And that's because in the end of the day, if society isn't willing to pay for it, it's very tough for people who are producers.
And it's hard to invest, I suppose, but you have to take some kind of risk, and you have to make some certain assumptions. Like, if you're going to build a cracker that's going to be, you think it's going to be around 30, 50 years, you do have to assume there's a carbon tax. If you look at like risk, you have to build that into the model. And even though all the conditions don't line up, a lot of these companies want some additional government incentives, and there's a question of whether there will be a carbon tax or when that's coming. But you can't really wait for that. I think you do have to take some calculated risks and make those investments right now.
Part of the issue is this whole game theory too, because if you've got all the different players, the problem is if they all don't decide to behave, then it's a lot like your group of friends go to a restaurant and somebody orders a lobster, right? They say, we're going to split the bill, and someone inevitably orders a lobster, right? So either two things happen. Either that happens and everybody's pissed off at James because he ordered the lobster and jacked up the average bill, or everyone orders a lobster because they assume someone else is going to order the lobster, in which case it's expensive for everyone. So that's part of the dynamic here, right? Because there are people, there are companies like China, which have a big influence on that. Now, what are they going to do if everyone does their job, but China doesn't fall into line in terms of coal, whatever? It's going to be tough for everyone. It's like the equivalent of, they ordered the lobster, right? No one got the lobster, they got the lobster, but everyone suffered because they had to pay more, right? So that's going to be a problem.
Yeah, but I think even China, maybe they'll be locked out of certain markets if they don't, right? If they, don't decarbonize, or they can show that they have they've lowered their carbon footprints.
You have to have a system of penalties, and that's what's going to happen. Eventually, it's not going to be, let's all agree and set goals and then compare notes every year, right? There has to be a system by which you can penalize those people who don't. So there's a cost if they're not. So in other words, you have to make it the penalty if you order the lobster, right? So that's going to happen. And they're going to come around to that, because otherwise the group dynamics, they won't get to where you really want.
And I think it was mentioned earlier, the idea of, Europe putting in, mechanisms for basically a carbon border tax. That's one of the things that helps get the globe in line. Like if you want access to the market, you're gonna.
Penalty, right?
You're gonna pay the penalty if you're not.
I think as someone pointed out, we have to get.
Go ahead, speak up so that we can hear you.
Okay, I
Pick
think
up so that the
someone
virtual
pointed out
people-
we have to get through a cycle, but clearly the cost curves and benchmarking are going to drive some of this in terms of crackers, right? People are going to want to understand, where do these new crackers fit on the cost curve with all of the new elements, and that will ultimately drive us to that lobster or not. Analogy you were talking about.
Do people feel, this is a question to not only the panelists, but those of you in the audience, do they feel that this movement towards complying with these things, there's an equal playing field, or is it going to tend to favor some over others, which is either cost of capital, whatever it may be, or ability to convert? Any opinion, either the panelists or so forth? Because if the answer is it's not an even playing field, you're going to have to rearrange the competitors, right? So anyone in the audience or any panelists who have a opinion?
Yeah, you do. Again, you do have to take a risk. There are, I think the playing field is, it is uneven when it comes to many factors, including feedstocks, infrastructure, that sort of thing. You just have to weigh, where is best to play in terms of producing the capacity, where your markets are, and does that all make up for it? Like, I suppose, big question for the ACC annual meeting when Jim Fiddling was on the panel was, why not build in the US? You're building here in Canada. Well, certain conditions have to be met, that carbon price, the price on carbon, as well as the CCS infrastructure, so that carbon capture and storage infrastructure. So some places have it, some don't. Some have cheap natural gas feedstocks, other places don't. So, you have to take into account all these factors. But I think it's not an even playing field at all. You just have to navigate all these different factors. Including carbon border adjustment tax and the price of carbon in different countries. They're very uneven.
Well, this is an unbelievable topic. We've reached our time limit for this unbelievable topic, and I just compared. I guess a couple of years ago, the two of you were panelists at my conference talking about the outlook, and I can tell you the topic was totally different, right? What we were talking about and what we said with the outlook was totally different. So it's very, very interesting. But I want to thank our two panelists who both brought some great wisdom to this topic of the outlook.